Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT and Jerome Powell's press conference. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So it was flat day overall for TLT. Yes, we had a 0.5 percentage point increase on TLT. We closed at 87.90. But throughout the day, we didn't really, fluctuate really away from the open. Really, we closed right where we opened, 87.90, basically. So again, we had a few attempts at going over $88, but again, we didn't really have any major catalysts. I mean, everybody was really waiting for Jerome Powell. Now, I'll say it now. So we get it out of the way. There is the geopolitical aspect to today's price action, and I wouldn't be surprised if we actually see some follow through. Now, I'm not a geopolitical expert. I'll never claim to be one, but the drama that we're seeing with Pakistan and India, if it kind of unravels, that could be an opportunity for TLT to really at least try and shine. All right, and again, a few examples of that. I wanted to point to 2022 as my first example, and that is basically when we saw the invasion of Ukraine, which basically puts us way behind here. Right here. So really, in the lead up to the Ukraine invasion, from the low to the high, we had a 5.5% increase on TLT, and you probably could see this better here, which is actually right here. In February, basically we had a 30 basis point decline on the 30-year bond yield. So keep an eye on that. I'm curious now that I mention it to see what happened in October of 2023, although that was around the peak. Well, actually, you did see a bid get into the long bond right here as we saw October 7th and the events that took that unfolded in the in the Middle East and in Gaza and Israel. So I would keep an eye. I would consider that if actually things get worse. Hopefully things don't get worse, so people don't lose their lives unnecessarily. But TLT usually gets a bid in that situation. We actually, now that I think about it, in September of 2024, we just for a few days there was some kind of crazy headline about Russia, nuclear war, and that stuff. And for a few days, we actually saw the long bond really react to that. I think it was around right here. I really don't remember, but in any case, geopolitical events can definitely have an effect. All right, so consider that. Don't put too much weight on it, but again, it is something to consider. As far as again, today's price action was really everybody waiting for the press conference, and again, as far as the press conference is concerned, it was a nothing burger. I mean, if you spent 40 minutes watching Jerome Powell speak at the podium, I feel sorry for you because I actually did. I mean, I wasn't really paying that much attention to it, but nothing new was said in this press conference that we didn't really know before. Powell reiterated that the Fed is in a good position to wait and see, which is consistent with what I said yesterday in my previous video. That is that the Fed is back at doing what it does best. Nothing. All right. Basically just just stays still and waits for something to smack it in the face. All right? Eventually, things get bad enough where they have to play catch up, like in 2008. And again, I've always made I've held the claim that this cycle right here is more akin to the pre-2008 world, where you have a boom and a bust. I mean, people will overdo it on the upside, and eventually they'll have to pay a price for it on the downside. And it is less akin to what we saw in the 2010s, because again, the 2010s was more of a malaise, a post 2008 depression, or really silent depression, whatever you want to call it. But again, a world where you had low growth and low inflation, because again, people were they didn't spend a lot in case another 2008 happened. So low growth, low inflation, and as a consequence of that, central banks reacted to that weakness in the form of QE and low interest rates. COVID, in my opinion, catapulted us back into a world that is more consistent with a pre-2008 world where you have booms and busts, all right? And actually, where the Fed stays up here, waits, and eventually has to play catch-up. Now, this can be a lengthy process. It is already playing out, in a possibly even a stretched out version of 2008. But again, my base case has always been that we would never see spikes in the data. It would play out as a process, a long process, but eventually, if things continue to stay like this, I wouldn't be surprised if it actually leads us to where, the road signs tell us we're going, meaning growth being softer than what a lot of people expect it to be. And if anything, this press conference really cemented, in my opinion, the idea that I've been pushing for about a month now, a little under a month, that idea is that ever since Trump walked back the electronics, tariffs on electronics rather, at that point the crazy headlines on tariffs were behind us. Now, that is not to say, again, that tariffs won't have an effect on the economy. They definitely will. I'm referring more to, again, the crazy headlines, the craziness we saw on April 2nd, the effect that news headlines around tariffs can have on markets. I think that will take the passenger seat, and as time goes on, we will go back to focusing on the fundamentals of the economy. We'll be forced to face the fundamentals of the economy, whether that is a stronger economy or a weaker economy. All right, whatever it is, we'll have to face it. But again, in my opinion, we are likely to move into an environment where we go back to this juicy stuff right here, meaning we have to focus on, again, the PMIs, the jobless claims, the non-farm payrolls, the whole shebang. And again, the best place to start is tomorrow with initial jobless claims. And again, I'm not the biggest fan of initial jobless claims because, again, I've pointed this out many, many times. By the time initial jobless claims start misbehaving, it's already game over at that point. If you're waiting for initial jobless claims to spike in order to ease and turn dovish, that is like, again, the example I've used is you're waiting to smell like rotten eggs before taking a shower. Yeah, great. You smell like rotten eggs. Of course you need a shower at that point. But the whole point is to get to a point where you don't smell like rotten eggs. That is why I'm always very critical of the Fed. And what kind of leads me to the idea that, again, it will be a process and eventually they will have to do more than they would have otherwise. And again, I still maintain the view that because of this view and because of the fact that the Fed reacts to whatever, and when it will react to whatever hits it in the face, the next rate cut will be a 50 basis point rate cut, simply because if you're sitting and waiting for something to smack you in the face, and something actually does smack you in the face, well, then you have to react to that, and at that point you're late, so you have to do more again than you would have before. So instead of taking it slow, you're more likely to see violent moves in the Fed funds rate at that point. So again, this press conference was really a nothing burger. Next month's meeting could could give us some extra clues, simply because, again, my base case is that we will have to focus on the economy, and I think that the economic data will actually move what we will see next month, given that next month is actually a Summer of Economic Projection month. So June will actually give us another Summary of Economic Projections, and depending on where basically inflation data comes around, and employment, and all that good stuff, we're likely to see some sort of reaction in the dot plot. And again, the dot plot is probably the best way to visualize the fact that the Fed reacts to something and it doesn't act in a proactive manner. The way one basic example I can give you is that last time I gave a very, nothing too consequential, but my outlook on the S&P was that these guys chilling out right here would take the elevator up, because at this point we didn't really have anything in the way of growth faltering. We had some worrying inflation prints. All right, we had just come off of the February CPI report, would actually put us at around 3%. I think it was this report right here. So, sure enough, that was the only thing they could react to. And so, lo and behold, these guys right here joined the party upstairs. And so it contributed to really making a more hawkish dot plot. So again, it'll be curious to see how the economic data comes out, especially in relation to what the dot plot will be, just to see, again, where members of the firm on the FOMC are. Again, tomorrow we get initial jobless claims, and depending on where they come out, that could actually give us an extra clue to where May's unemployment rate could potentially be. Again, I'm not a big fan of initial jobless claims, again, as I said before, but generally speaking, anything above 220 seems to be kind of the break-even point for initial jobless claims. Anything above 220, you get an indication that probably the unemployment rate will move up. Anything below to 15, really, you can expect the unemployment rate to move lower. Now, we have a forecast of 230K for tomorrow. I mean, we could easily see this backtrack down to 220, given previous moves. But who knows? It'll be interesting to see. And again, that is for tomorrow's data. Next week we have inflation. We're actually expecting inflation for the these first forecasts that we have, inflation to be a little bit hotter. And again, we'll have to deal with that when the data hits. So again, I think that overall, what this press conference actually did is actually help cement the idea that, yeah, we know everything about tariffs. We know we saw some crazy stuff, all right, in the past month. Now we have to see how much damage has been done. Has any damage been done? Has a lot of damage been done? Whatever the case may be, we have to face that music, that kind of music, all right? And really what that means for TLT is that we are, in my opinion, in an environment where bad news is bad news and good news is good news. I think that this press conference, kind of in its boringness, really the only useful thing it does is kind of put a demarcation line between the era of good news is bad news and bad news is good news. I think at this point, from this point onwards, really, I think it's pretty safe to say that we are in an environment where bad news will be bad news, meaning that if we get higher in initial jobless claims, that will be regarded as bad news. Because again, before, really up until the summer of 2024, the market was really rooting for rate cuts. And so any kind of negative data was seen as good news because that meant the Fed could cut, all right? And good news was seen as bad news because that was an indication that the Fed probably couldn't cut. I expect the opposite right now. Any kind of bad news will likely mean the Fed will cut for the wrong reasons, all right? It's not going to be the juicy cuts that we're waiting for, all right, in 2024 and 2023 and in the first half of 2024. It's the bad kind of rate cuts. The rate cuts that are reacting to weakness. And if we get good news, it'll be good news in the sense that the Fed won't have to cut rates because the economy is doing fine. So that is my base case going onwards from here on out. And I also would consider the geopolitical aspect because, again, I mean, yeah, everybody wants their bags to get pumped, but, I'm pretty sure we're not, in the psychopath area where, you want people losing their lives for no reason. So, again, I would keep the geopolitical aspect in mind. Hopefully, stuff doesn't, deteriorate between Pakistan and India at this point. But if things actually start to look worse, that kind of flight to safety trade, or at least in the very short term, could actually bid up TLT. So hopefully we don't get that. But at the very least, consider it. So again, just to summarize, this press conference was completely useless, except for one thing. It just basically said what everybody already knew, that is that the Fed will react in the face of bad news, meaning that we are now officially out of the era of bad news being good news and good news being bad news. We are in an environment where we'll have to face the economy, however it may be. It may be stronger or it may be weaker. I don't know. We'll have to just wait for the data to come out, starting tomorrow with initial jobless claims. If you like this kind of content, consider leaving a like and subscribing to the channel. And I'll see you next time. Bye.